Hello, hello, hello. Good evening, everybody. This is Stanley from Value Invest Asia. How are you guys? Hello, hello. Let me know if you can hear me, and why don't you guys let me know where are you connecting from? Are you connecting from Singapore, Malaysia, Australia? We have some people joining us from the US as well. Hopefully, how are you guys? All right, let me just set up. We are gonna talk about so many things today, uh, all surrounding what we might be thinking about the stock market in the next few months and also the year ahead in 2020. Hello, Melvin. How are you? Hello, Handy. Handy, you're joining us from Indonesia. Thank you. How about Kabar? Hi, from Kuching and Penang. Tan, how are you guys? Thank you, thank you. Thank you for joining us. Hopefully, you're able to see this. I'm going to just switch over to my presentation for today. All right, here you go. Um, Although this is a YouTube live session, but do note that there is still gonna be like a 20-30 second lag from when I speak something and when you see it. So along the way, I got a short presentation on what I think the market is gonna do. And why don't you just go ahead, and if you have any questions that you want to talk about, you want to discuss, just go ahead and ask the question on the chat box, and we will have a question and answer maybe at the middle of the presentation, and then we'll have a more deeper chat on what's really on your mind right now. All right, and let's get started. Hey, hello, Kelvin, and Hui. I hope I pronounced that correctly. Yeah, today I want to share with you just a little bit on where the market has been, what the market has been doing, and what we can sort of expect in the coming few months and on the year ahead as well. So basically, when we look at what has been happening, say in the past 10 years, maybe 11 years now, we have basically witnessed the most epic bull run of the century, right? And just from after the global financial crisis till today, the stock market has really gone up, 2 to 3 times from S&P 500, and most market has at least doubled since then. And we have never seen such a great bull run ever in almost the history of the stock market, right? Since the early beginning of the 1900s, when the stock market came to be, on average, I found this article from CNN where they done the calculation. An average bull run in the US market, and I guess everyone else sort of track the US market as well. So the US market actually, on average, their bull run is only about 5 to 6 years on average, right? That doesn't mean that, always all the bull run is 5 to 6 years, but we can see from this table that some of them is roughly 5 to 6 years. Some can be as low as just 2 to 3 years. Some can be longer, 8, 9 years. But till today, the recovery since the global financial crisis, this one has been going on for close to 11 years now. And you know uh, we have finally starting to see some sign that the the end is near, maybe, right? uh, but maybe not quite there yet as well. But I just want to highlight to you, in an interview by CNBC, Bill Gates, he is right now running one of the largest personal portfolio. Ever since he retired from Microsoft, his endowment fund, his foundation fund, is one of the largest private investor out there. And he, in the interview, he said that basically there's reason that we have to adjust our expectation right now, that the absolute return in the next decade, coming decade, will sort of be less than what we have been experiencing in the last decade. I don't know what he truly meant by that, but it's sort of he is adjusting his expectation. In the last 10 years, everyone is getting 7, 8, 9, 10, 12% a year return if you have been invested in the market. I think it's time that we might need to adjust that expectation going forward as well. Because when you look at it, there is a lot of problem with the world right now. I'm not saying that the problem has never been there, but you can see that it sort of is starting to boil more and more, and especially when we look at the media cycle. What the media like to highlight, of course, they like to sensationalize a lot of things, but we can see that there is definitely more bad news than good news out there right now, from the trade war to the Hong Kong protests, which is very widely covered right here in Asia, to we're talking about the possibility of regulating technology company like Google or Facebook, given the loss of trust with them, and throughout the world, we are starting to see the rise of more extreme politics, both I guess right here in Southeast Asia as well as in the US and Europe is quite dominant, from both the right and the left. It's getting more and more, I guess, ridiculous is the word, and even the Syrian civil war has been going on for so many years, and finally, at the beginning of the year, it seems that there is a chance of it's coming to an end. But right now, with the U.S. Retreating its troop away and Turkey invading in Syria, I guess the mess is gonna start all over again. So not much good news out there. And one of the things that we track is this index called VIX index. If you haven't ever heard of it, you can find it on Yahoo Finance, or if you use Bloomberg or CNBC, you should be able to see this index as well. I encourage you to take a look at it. And what this index basically track is the volatility in the market, right? And volatility can go both ways. If the market is constantly going up and with a wild swing, that is increase in volatility as well. But more often than not, volatility measure when there is too much up and down swing, which is what's happening now, where the market swings up and down too violently, just based on nobody have a clear idea what's happening. And when you look at it, typically in stable times, it will be around 10 to 15, the index. In the extreme version during the great financial crisis in 2008, it actually shot up. I have the chart here to 60, but some of the days it shot up to more than 80 or close to 100. So that gives us a sense of where real panic will be when there's real panic, what the VIX index will show. Right now, the VIX index is not too, I'll say in the middle ground at around 19, 18, 19. And it has been edging up slightly. So I guess there's going to be more volatility in the market, but not so much that we are at the extreme fear mode yet. Why don't we do a poll here as well, right? Why don't you tell me, are you feeling fearful or greedy right now? Are you thinking of staying at the sideline at the moment, Or are you thinking of it's a great time to be bargain hunting right now? Why don't you leave it in the chat as well? We get a little poll running, so we get a sense from all of us here whether there's fear or greed in the market right now, right? And another thing that we sort of track is this thing called yield curve. So you might have, if you follow financial news, you might have heard that the yield curve has recently inverted for more than 2 quarters. So what is the yield curve? So basically, the yield curve is just a measure of where the treasury yield is for the US treasury bills. And so from the short term one, from the 1 month to 3 months, 6 months, 1 to 3 years, all the way up to the 20, 30 years T-bonds, T-bills. So typically what happened is as the duration increase, so as you're buying a longer and longer T-bill, most likely the interest rate will be higher and higher, because if I'm going to buy a bond for 30 years, I want to be more better compensated. So I like it to be higher yield, and then it makes sense for me to buy. And when I'm just having a short-term bond, I don't mind having a lower interest, right? That's logical. But what has happened recently is that has sort of flipped, especially in the region of 1 years to 10 years. It has flipped where the longer term yield is actually now lower than the higher bond, the shorter duration bonds. And in history, okay, there's not much logic to it, but in history, statistically speaking, when this happened, within the next 1 or 2 years, we might be seeing a financial crisis, right? Don't ask me, where is the logic in it? I don't quite understand myself, but just from reading some of the statistics, that has been the case throughout history. Right, and it doesn't mean it's going to happen straight away. It just means that it could happen in the next 2 years or two plus years time frame. So that's what history has told us. Doesn't mean that it could happen this year, or it could happen. But there's something that to think about, and I think definitely increase it lowers the confidence level of a lot of investors out there right now. So that's something that has been happening in the world of finance. But what could we do? Now, what could we really do? Should we really just sell everything? What do you think? Should we just completely sell everything? I'd like to give you an analogy through this example first. Does it really make sense for us to just sell everything, or what we should be doing? We have two investors here, right? One investor is a very fundamental based, long-term investor. He believes in value investing, and he has one stock that he believes in, and that is Singtel. So, and he buy your whole portfolio on Singtel. Whereas we have another investor. He's an investor slash trader, right? And he doesn't have a fixed rule on how he invests, but he is very diversified. He buys everything. He don't mind trying everything. So he even buy some crypto. He has a trading portfolio where he do day trading, and he buys stock from all over the world, even some bonds, some gold. We have two very different investors right here. One very fundamental, very value based, and the other is a bit of mixed bag, I guess. In our language, maybe rojak. Okay. So which one do you think has a riskier portfolio? Is it the value investor, or is it the investor slash trader? And in fact, I'm quite sure that you guys would most likely say that it is the guy that have a more diversified portfolio who has less risk. So the guy that only bought Singtel has a higher risk, right? And that's basically true, because he's not diversified and he's exposed to one key risk. If anything happens to Singtel or to the telco industry, and then his whole portfolio might be completely, not completely, but could be very drastically affected. So investing at the end of the day is not about picking the right stock, or it's not about whether you are a trader or you are a value investor, or you're a growth investor. It's none of that. Investing at the end of the day is just about risk management, right? The Warren Buffett famous quote is, I don't know if he really says that, but if you search the internet, the famous quote is, rule number one, don't lose money. Rule number two, don't forget rule number one. Right. So investing has always been about really about risk management. And so even if the market is going to crash today, it doesn't make sense for us to completely just sell out everything. For number one, we can never predict the market. If you ask me, even 4 or 5 years ago, I feel the market is quite high. And if at that time I decided to just sell out everything, I would have lost out on the bull run over the last 3-4 years before the market turns a little bit recently. So we can never tell what will happen. And even if today we today after this live, tomorrow is the start of the bear market. In history and statistically speaking, when we look back at all previous crashes, typically the most a market falls, they fall for about 2 to 3 years. They will have a bear market of about 2 to 3 years. Okay, so bull run, typically we have a 5 to 6 year bull run, and bear market, this is not average, and this is the most, okay, from my research, the most that the market will last in a bear run is about 2 to 3 years. The average might be just 1 or 2 years. And what most likely happened, from what we see over the past last financial crisis, if a crash really happens, a lot of most of the government will try to step in, and they try to address the market. And most likely what they do is they're going to print more money, especially the US or the Eurozone. And that they hopefully, because that they will try to avoid deflation, which is much worse than inflation. So they would they don't mind printing more money and just try to get it out of the recession. And if they're printing more money, and in the future that will lead to inflation, because more money could lead to inflation, meaning our money is not worth that much anymore. Then if that logic makes sense, then cash would end up to be the worst asset to be in, even in the bear market, right? So if that's really the case, and if we are investors who is okay to invest for, say, the next 2 to 3 years, we are able to at least wait for the next 2 to 3 years, then it doesn't matter if we would be facing a crisis soon. What is more important is actually we take a look on a longer term than that. And if we are able to hold on to the next 5 years, then even if the market crashes for the next 2 years, we know that by the end of the 5 years, most likely the market will have recovered anyway, right? So let's take a poll here. Do you think the market is going to be up or down in the year 2020, right? Just up or down? Let me know, and I'm gonna share with you what has happened over this year, and going back to that. On how to position our portfolio right now. If you have the time to wait for the next 2 to 3 years, even if a crisis hit today, then the best way for us to allocate our portfolio right now is looking for long-term stocks that is able to be in a long-term growth trend. Because this is what happens in for a stock that is having a long-term growth trend. It might crashes, right? It might crashes at this drought during a crisis, but then it makes sense that we start looking at this kind of companies and maybe be starting to accumulate more on higher quality stocks rather than stocks that might just happen to be undervalued at the moment, right? There's a difference between undervalued stock and high quality stock. A high quality stock can be undervalued, and undervalued stock can be high quality, but they're not the same thing, right? And at this moment of time, I think it's better for us to concentrate more on the quality side of things rather than just on the prices. Okay, and where can we find such company with a long-term growth trend? I have two examples for you guys. I think two sectors that I really like, and I think that they would have still a long runway to go in terms of growth, regardless of whether we see a recession or not. One might be debatable, but the first one is technology, which is a sector I really like if you have been following us. And the next one is actually the luxury market. It's counterintuitive that you might think that, in a recession, why would the luxury market be good? But hang on with me. I'm gonna explain. Okay, first the technology. I think at this moment of time, technology has really become the new space race, right? And this is technology and data in particular is becoming the new oil of the century. And so in this connected world that we are living in right now, the one that really control the data and control the technology can control the world. And we are basically sort of seeing right now the technological space is really, really dominated by either US firms or Chinese firms. They are, I guess, head to head in many of the main sector. We're going to share a little bit about that. And we can see that even if tech company in the US would end up being regulated, I think that's actually a good thing for them, because when regulation comes in, it increases the barrier of entry for new entry, and it actually solidifies their position. And the government don't really want to hamper their growth, because if the US firm is hampered in growing, the only alternative out there are Chinese firms. And, for the US government, that is even a worse option than having a monopolistic US tech firm in charge. So I do think that both government will still try to encourage the technology company to continue to grow and gain market share, and that will be a key sector where a lot of growth will happen. And if you look at across the board, from hardware to software to components, in many areas there's already a consolidated market, so there's not too many big players out there anymore, and in each sector a few guys control the niche. And if you look at, say, the 5G space, the telco equipment space, you have, of course, Huawei, Ericsson, Nokia, and Qualcomm. All of them are quite almost toe-to-toe with each other. If you look at the manufacturing capacity, whether if it's chip like TSMC or Samsung or Intel, or even the hardware, you are basically dominated by a big guy like Foxconn. So these are companies that you can definitely take a look at. Even if you talk about computing component like the CPU, you can see that there's basically a very consolidated market with Intel and AMD in the PC space, and in the handset space or smart devices space, it's mostly ARM chip, architecture chip, and they license it out to people like Qualcomm, Apple, Samsung, or Huawei HiSilicon. And again, there's not many players for us to choose at. And if you feel that this trend will continue to grow, that's basically just these few companies for us to keep watch of. Even in the GPU space, if you know a little bit about this space, is also dominated by basically two guys, Nvidia and AMD, both listed on the US. So these are some of the companies that I truly think that you can start watching them and adding it to your watch list, and they will become very interesting. Even on the software space, when we look at operating system, most of the operating system out there is by Microsoft, Apple, or Google when you're talking about Android. Of course, Linux as well on the server side, but that is not a listed entity and is not something that we can invest in anyway. So it goes down to the three guys again: Microsoft, Apple, and Google, which is Alphabet. Even in the cloud space, is also even such a new space such as cloud computing is also a very consolidated industry now, with Amazon, Microsoft, Google being very dominant in the space, and also in Asia Pacific here, Alibaba is quite strong as well. So there's not too many guys for us to watch, and if you are looking at long-term trend and high-quality companies, I basically sort of give you a list here on the watch list that you can think about. Now going to luxury, I do think that the luxury space is turning quite interesting. Mainly, of course, coming from the rise of the China consumer, and a lot of them has already pivoted to servicing and targeting this main group of consumer. And you can say that economic slowdown, then people might spend less, yes, but we have seen again and again wealth distribution doesn't have to be equal. And both in the US and especially in China, wealth distribution has not been equal at all. And even at the time of recession and everything, we have seen the rich still getting richer, especially with government doing a lot of QE, which pump up asset prices. And we know that rich people has more asset, and that end up them having a higher percentage of wealth over time. So and brands name are really adapting to that, and also starting to create much lower tier price accessory. Instead of selling you, say, a $50,000 bag, they might sell you a few $100s keychain or a money clip to get you started with on the brand itself. So they're adapting, and I think over the longer term, they might continue to do very, very well. Okay, and if you look at the luxury space, again, very, very consolidated space, mostly listed in in Europe. So you can look at company like LVMH, Christian Dior, right, Hermes, all listed on the in Europe, and also Burberry Group, which is listed on the London Stock Exchange. In Hong Kong, interestingly, Prada is listed in Hong Kong, and also they have their own brand name such as Chow Tai Fook. Something you can look at, but I would be more cautious on the Hong Kong local luxury brand like Chow Tai Fook. Okay, cool. Yep. Going back to our poll, right? I'm just looking at. Let me refresh my chat here, and I'm just looking at some of your comment on the poll of whether you think you're fearful or greedy right now. What you think the market is going to do, up or down? Most of us might be a little bit more cautious. I can see Friends is saying it's time for hunt. Very aggressive. Clarina is saying more cautious. Kelvin is staying on the sideline, and Richard is staying on the sideline. That's the general sense that I get. And but interestingly, I wanted to prove that sometimes it's very hard to predict the market. And even with so many bad news in the market this year, interestingly, most of the market this year has actually been up. Even the Hong Kong market. I don't know for the next few next few weeks what will happen, but at least until today, the Hong Kong market is actually still up. And if you add back dividend, you are actually getting quite a good return this year, even from the Hong Kong market. And that's the same for the STI, slightly above, slightly higher a little bit. the US market has been doing very well. The only market that we track that is not doing that well is actually turned out to be Malaysia. And Malaysia was actually, you would say that economically or just socially is the one that people are most optimistic about, because with the new change in government, there's new sense of optimism in the market. And yet it turns out to be this market is actually the only one that has declined this year. So again, it's I just want to showcase this result, because to let you guys know that it's very, very hard to predict the market. And the market will continue to do whatever it likes to do. And we should really focus not so much on what the market is going to do, but rather on high quality companies that can continue to grow for the long term. Okay, and that's basically, and a lot of the stock that we cover, especially within our VIA club, that's basically what we try to look to and introduce our members to as well, which we can talk a little bit about later on. But let's get back to what you guys want to talk about first. And I'm looking at some of your questions. Let's go to your question right now. All right. I'm scrolling back to the past few chat first. Okay, we have Nori asking me should we be buying gold and selling 10 cents. To be honest, if you have a portfolio and if you are looking, if all your portfolio are stocks, and you're looking at ways to have more diversification with it, actually gold is not a bad idea, and you it's definitely a worthwhile idea to look at. I personally don't own gold, but I don't know why I don't own any gold. But if you're just talking about as a way to diversify away, definitely I think gold is worth looking at. If you can hear some background piano music, that's just my kid practicing in the next door. So she's gonna give you some background music for a while. Okay, and 10 cents. Should you sell 10 cents? I don't know why you would have that idea. Personally, I'm not selling my 10 cents. If you are from our VIA club, you know that 10 cents holding is actually one of my largest positions. It's a company I love and I continue to like it, and I don't see why there's a need to sell 10 cents. And in fact, I think 10 cents is definitely on the way to become a bigger and bigger company over time. So, I'm not too worried about 10 cents, and I think there's still a long way to go for the company. Okay, cool. F. Hamley is asking, you have two questions. What do you do if you have bought one Sembcorp Industry at 360? And number two question is Ascendus REIT a buy at current valuation? Okay, thank you very much, F. Hamley. Okay, number one, Sembcorp Industry, I would say, to be honest, it's not a company that I really like. And the part that I don't really like is actually its subsidiary Sembcorp Marine. But there's just so much exposure with Sembcorp Marine that it's going to be affected with Sembcorp Industry. As a utility company in its core, I think that would still be relatively okay. But we are starting to see, of course, in Singapore, deregulation and things like that. To be honest, if I own Sembcorp Industry right now, I might really consider selling it and putting my money into some of the more higher quality companies that we talk about just now, or if you come across. And higher quality means the company that at least has very strong free cash flow, company that has low debt, and company with quite consistent ROE or profitability. So these are companies that I prefer. And if you know how to look into company with a moat, economic moat, then you can look into company with economic moat. But most company with very strong economic moat, they tend to have the characteristic that I talk about: low debt, high free cash flow, and very good and consistent ROE. So if it is me, I would actually think about cutting my loss and looking ahead at the high quality companies. Sanders REIT, to be honest, is one of the REIT that I quite like in Singapore. But the problem is REIT in general right now in Singapore is not very, very cheap. They have been really appreciating quite strongly, and I think it is a little bit too pricey at the moment. Most REIT, including Ascendus, for me. How I would really look at REITs is basically just looking at their distribution yield. And I want a REIT that has very stable or a growing dividend yield. And I want that yield to be at least trading at its higher bound. So if you just track back its yield in the past few years, I think you can do that from SGX stock fact. If you just track that, you should be able to see on average where is the yield band. And typically I like to invest in REITs when the yield is on the higher side of things. So I'm getting a better yield, meaning when the price is lower. Right now, most of the REITs, they are trading at a lower band in terms of their yield, which means they are slightly a bit pricier. And that's why I might stay away from REIT at the moment. But Ascendus REIT, definitely a high quality one that I like. Okay. Let's go on to the next question. We have Peter Lai. You're asking how can we find valuation on S&P 500, Dow Jones, and compare it with the past. This provide a gauge. Okay, so one way you can actually look at it is just look at the passive ETF. So you just go to ETF website like I think ETF.com, ETFDB.com, and when you look at some of, say, the S&P 500 index ETF or the Dow Jones ETF, and they, in their stock facts, they typically have the average price to earnings and also average dividend yield. So that gives you a sense of it. But from the latest report that I just read from one of the news media, I think the S&P is trading around 18 times at the moment. Not super high, but not super low. They're slightly higher in the average band. Okay. And FMH F Hamley is asking, is a recession imminent in year 2020? Yeah, I'm gonna go out on a limb and say that 50% is gonna go up, 50% is gonna go down. I wouldn't know. I really don't know. But what I'm doing now is really gearing my portfolio more and more towards higher quality stocks, and I'm staying away from a lot of the small caps, a lot of the company that just looks cheap, but might have no moat or might be in a industry that I'm not comfortable or not very familiar with. So those are the companies I'm staying away, and I really starting to look more and more with companies that has a very strong moat. It could be branding, it could be they have a massive scale in their business, or they have maybe some technology company, they just have a dominant platform like, say, Facebook, which is also a stock that I own. No matter how people hates it, how many people don't like Mark Zuckerberg, and when you see him speak, you might say he sounds like a robot. But regardless of all that, most of us is still on Instagram and WhatsApp and Facebook. So these are some of the companies that I look at that they really have a very, very strong economic moat that can continue to help them grow in the future. Okay. Uh, okay. Next, Roger is asking, isn't health and consumable industry more recession proof than luxury? You're right. Actually, you're right. Yeah, but I just want to give you guys a little bit twist, because if I say recession proof, every time it's going to be the same thing. Everybody's talking about healthcare or consumer companies. But I would still go for the very high quality consumer companies rather than the smaller, brands out there. But if you look at, say, your Nestle, your Unilever, your P&G, those I quite like. And But to be honest, when as I described just now, I think the luxury market might actually be more recession proof than all of us might assume. Okay. Hi Chris. Where can I find the stock guide 2019 in VIA Club? Why don't I reply you in off chat message later on? Okay. I think it's a good time to buy. David is saying I think it's a good time to buy Bank of China, Hong Kong, now at a low price due to the Hong Kong crisis. What's your opinion on Bank of China, Hong Kong? I don't own Bank of China, Hong Kong. I do own Bank of China. This is a sensitive topic. I'm a bit worried for Hong Kong in general, and I would stay away from company that is too Hong Kong centric. Of course, BOC Hong Kong is just a subsidiary arm of BOC, but because they just have the Hong Kong business, I would be more worried about it. If you're thinking of it, it might be safer, I guess, to consider the Chinese banks, because or BOC directly, because BOC still have business, still have a huge stake in BOC Hong Kong. In fact, Bank of China Hong Kong is one of the top 4 banks in Hong Kong itself. So they still have a huge exposure to it, but they are sort of buffered by their China business. If anything structurally happens to Hong Kong, BOC China is still quite strong. So I think that will be a safer bet. If you're looking at like Hong Kong specific company right now, I guess the risk is much higher, and it's almost like it's almost like a 50-50 bet. I don't think any of us can really predict what could happen or how the Chinese government might react to it. So it's a risk that I'm not willing to take at the moment. So if a company that is declining, but their business is actually not so focused in Hong Kong, then I would prefer it, to be honest. Okay. Melvin is asking, assuming that the market condition is relatively bearish in the coming years, are you saying that tech and luxury will likely to do better than other category? So other category depends on what category though. If you say on a general market sense, yes, I think I personally think that these two sectors would still have the tailwind with them. I generally stay away from even what else is commodity. Yeah, maybe around here is mostly these two. So I tend to stay away from those. I would say more resilient sector would really be tech, consumables like consumer, healthcare. But healthcare I'm not very familiar with, so it's like sort of outside my circle of competence. So I don't really look into healthcare that much, and sure, the luxury space as well. Cool. Brendan, what about Bank of America and Citigroup? I think the US banks are quite reasonably priced right now. I think the stigma of them from the great financial crisis is sort of still around. So they are not as highly valued as a lot of the other large US companies. I like them. I like them, but to me, the banks, a bank is a bank is a bank. Doesn't mix. I don't see what's the difference between, say, a U.S. bank or a Chinese banks. They all have problems. People say they're worried about China, shadow banking and things like that. The U.S. banks have a lot of shadow banking as well, which caused the 2008 financial crisis in the first place. So I have no prejudice against one or the other, but it just turns out to be the Chinese banks is slightly undervalued, more undervalued than the U.S. firms right now. So I end up buying some Chinese banks, but I wouldn't fault anyone if they like the U.S. bank. I think they are quite fairly valued right now, and some of them are pretty good. And Bank of America, Citigroup, and Wells Fargo are all pretty decent things that you can look at the moment. So what is the best China ETF? Sean is asking, what's the best China ETF? Okay, I tend to follow the China tech firm more. So I know a China tech ETF which is called CQQQ. CQQQ, where they basically invest in all or most of the larger Chinese tech company. I think they have 100 plus Chinese tech company, but of course it will be dominated by the bigger guys, which is Tencent, Alibaba, and surprisingly, I think Meituan Dianping, and JD and Baidu, those are the higher weightage company. That's something you can look at. Or I think SGX has a A50 China ETF, or you can just go to etfdb.com and just search for the China ETF. I think there's a lot around, but generally China ETF, their cost is slightly higher. So take a look and compare which one might suits you more. Damien is asking, Hong Kong Land. Personally, I don't like it. I know it's very, very cheap right now. And I think if Hong Kong resolved the problem, at least the protest subside, all Hong Kong linked companies would rebound, definitely. But structurally saying, it again go back to what's your view on the future of Hong Kong structurally. But structurally speaking, I do not know. I do not know structurally what is the future for Hong Kong. And so, if I do not know and I just assume the worst, then property in Hong Kong would no longer be that high in demand, and the cap rate in Hong Kong property, they tend to be very low at the moment, but maybe they would not be that low anymore. So all this could affect company like Hong Kong Land, and of course your Swire Pacific and everything, and your Cheng Kung Holding and all of them. I know they are very cheap, very tempting, but for me, it's still too much uncertainty. That's why I'm staying away. But if it all depends, it goes back to investing is all about risk management. If you're sizing it not too big and have a diversified portfolio, then I don't see why not it could be inside your portfolio, as long as you size it correctly, right? Okay, Chris, the idiom of invest when others are fearful and run away when others are greedy, how does it apply in Hong Kong? Definitely a lot of people are running away in the Hong Kong market. You can be greedy, but so to me, I think I still like to go back on what is investing. I think to in my own opinion, is quite a personal journey, because it goes back to what your own view of the world should be, or could be. And if you feel that Hong Kong will continue to grow stronger, and the future is bright for them, in the future, and this is just a temporary issue, and they will resolve it, then definitely if that suits and goes to your own belief, then yes, I agree that it can be a time to be greedy. But if you don't think that way, which I fall into that camp where I'm uncertain of structurally what could happen to Hong Kong, then it will be a complete market that I just would not try to go into, because it will fall outside my circle of competence. So I rather stay within my circle of competence, and I in industry or in sector that I believe that there's still a long way of growth for them, and if the company is just temporarily affected by what is happening right now, then those company I would really look at. So case in point, just now, I think Nora is asking about Tencent. I think Tencent is one of such company where, because it's the largest component now in the Hong Kong Hang Seng Index, and it's also a Chinese firm and listed in Hong Kong. So they are definitely affected. Haven't dropped a lot, but still it has been dropping. And when the price is right for you, I think this, I don't mind investing in such a company. Okay, Alice, what is your view on the Vietnam market in 2020 and beyond? Alice, I have to be very honest with you. I do not know. And it is definitely something that I continue to learn, but I don't think I'm in the good position to answer anything about Vietnam market. If you have some insight, I'd love to hear from you. Okay, Calvin, you're talking about what's your view on MTR, and since MTR station has been badly damaged and the station is closing, and the stock price is dropped, and what's your view on... Oh, there's two questions. Let's look at MTR first. MTR is one of those companies that, it goes back to, it's very Hong Kong centric, and I typically stay away from that. But I would say of all the Hong Kong centric company, MTR might be the more resilient one, because they're just providing a public service. All the damage that's done, I think it's just temporary. They are all insured anyways. As peace comes back to Hong Kong, hopefully it will go back to normal. They'll repair and the insurance costs. What is going to be affecting them is the rental that they're collecting from the retail space that they own in the MTR station, because of the closure and everything and the damage. A lot of shop is suffering, and that will affect their rental as well. They are, I think, giving some relief to the rental, but if their tenants go out of business, and if the future for Hong Kong, there's not so many tourists anymore, and then that could have a longing effect on MTR. Not so much on the train service, but on the rental itself. So that's something to look at. Trade desk, US stock. I heard a lot about it. I'm still learning about the company, so I really don't have a view on it right now. But I heard many good things about it. If you want to take it offline, I love to chat with you about it. Friends is saying, like Mr. David, I have my eye on Hong Kong banking sector, although I prefer Bank of China. What's your opinion on Hong Kong banking sector going forward? Wow, a lot of questions on Hong Kong today. I think it's the same as I talked about just now. So it goes back to your own expectation on what will happen to Hong Kong. I think Hong Kong financial sector, on my own view, is Hong Kong financial sector will have a very, very tough time going forward. We've seen recently Hong Kong exchange, right? Yeah, friends, now you got me excited. You see, Hong Kong Exchange recently tried to buy the London Stock Exchange, and they got rejected. A slap in the face, where the London Exchange basically, I'm paraphrasing here, but they basically say that they don't look up to Hong Kong, but they look to Shanghai as the financial hub of China. So, they're sort of hinting that Hong Kong is not worthy of being the acquirer. And I think is the sad truth for the Hong Kong financial sector, because as China become more and more powerful, it will need to open up more and more. It cannot be a close and powerful and international economic power. So as it becomes stronger and stronger and it feels more confident with itself, it will open up its market. And when it opens up its market, it means that there's no need for a financial hub like Hong Kong that helps you go through Hong Kong and go to China. You can go directly to China. And the financial hub of China is in Shanghai. So Hong Kong might have Hong Kong financial sector might need to readjust, and they might need to think of ways to look into how to position themselves. If they're gonna just be continue to be an offshore financial sector, I don't know, then they have to compete with many other places as well. So I'm not too optimistic about Hong Kong banking sector. That's why I'm staying away. And I'm definitely staying away from the smaller guys. If you're talking about like the big guys, your HSBC, your Standard Chartered, Bank of China, Hong Kong, Hang Seng Bank, those are the big ones. And I think if anything happens, those will be more resilient. I'm really staying away from your like Bank of East Asia, and what's the other smaller ones? I couldn't remember, but Bank of East Asia. Those are the ones that I really will stay away from, regardless of how cheap they become. Okay, how about? Oh, we're almost at an hour's time. Let's take one or two more, right? I really like to share with you a little bit more about VIA Club and what we do at VIA Club. If you want to know more about that, stay till the end. But let's take one or two more questions. Okay. Fei Luo asking, how about the telco industry in Singapore? Another question that I like. I don't like the telco industry in general, and that includes the telco industry in Singapore. If you look to some of my past YouTube videos, you have seen one that I say why I don't like the telco industry. The gist of it is, I'm going to summarize because you can check back on the video archive and you can see it in entirety. But I'm going to summarize. Basically, I think the telco industry is going through a transformation where they used to have a lot of property, very valuable services that they charge us very high for, such as phone calls, SMS, and pay TV, right? And later on data. At the beginning, the very profitable ones: voice, SMS, and pay TV. But now, as technology improve, all we need is basically data. Because I never make my phone call anymore, because all the calls that I keep getting are spam calls and I never pick them up, and I only call through WhatsApp, and I don't watch pay TV anymore because all I watch is Netflix, and I don't SMS anymore because I WhatsApp or Facebook Messenger or DM in Instagram. So end up all we need from a telco is data and nothing else. And this means that they comes from serving very highly priced and services that we need till they become a commodity supplier where I just need data. And with the deregulation of the telco industry by the government, which I think is a great move, and it means all of them have to compete for us. And which means they compete on price because all of them is the same. They're all using the same cable from Netlink Trust, right? And so they're basically a reseller now. And to me, it means that the service will more or less be the same, especially in Singapore. And so it goes down to price. And from a very profitable services, a few services that they have, end up they only compete on one commodity products. That's why I'm not very optimistic about them. And you can see that a lot of them trying to diversify away into many other business. M1, which of course is privatized, but they going into more enterprise services, doing POS systems and things like that. StarHub is also doing a lot of more enterprise security and things like that. Singtel try very hard to go into tech, and also adding a lot of security and services to them, enterprise services to them. So they are struggling to find new ways to reinvent themselves, which I rather not wait for them to reinvent themselves. I can just invest in the services that I'm using, which is WhatsApp, Facebook, or what else do I use? Mainly Facebook. Okay. Okay. I think that's roughly it. So yeah, that's wow, there's a lot of questions from you guys, and I think there's a lot of interest in Hong Kong. So thank you so much for your questions. But before you guys go, I really want to spend a little bit of time on our VIA private club, which I do get questions from you guys on what exactly is VIA private club, and I want to share a little bit more on that. So on our valueinvestasia.com website, those are our free site where you are free to read, and we publish our podcast and also a lot of our articles on them. But on the VIA Club, it's a closed site by invitation only. And this site, I actually publish my entire portfolio for the members. So all the members can see my entire portfolio, down to the number of cents that I bought into this stock. And I give an update, month-to-month update on what's happening to my portfolio and what I think about it at the moment. And I also give a live trade update. So every time before I buy or sell a stock, I actually give out a notice to my members to say, hey, I'm buying this stock, I'm selling this stock, and why is that the case? And so this is basically what we do within VIA Club. I tend to, so you can see this is my part of my portfolio that I have. I think this is a snapshot taken a few months back. And we basically run through a lot of close research that we give to our members weekly. It can be a stock report, it can be a market update to our members, and we also include a monthly stock of the month report. So every month I would choose one of the week to publish a stock of the month report, whereas that will be the stock that I like the most for that month, and we will track the performance of that stock for members. We also have behind the scenes podcast access. So we are running two podcasts. One is the Asian Mavericks and one is Investing Ideas. Actually, the episode number 3 is going to be out at 9:30 later. You will be able to see it on our website and also on our YouTube channel, where every week we will interview a very experienced investor on what is the stock that they like every week. This is our first episode on OCBC and UOB, where a fund manager is saying why he thinks that it is undervalued. If you have not watched it, you can go back to our YouTube channel to view it. And for VIA Club members, I include after review. So after I have the interview, I do a review on the idea and my interview, and this is only for members only. And of course, we also have access to our community, basically our Facebook group, where everybody can discuss both the stock of the month, my portfolio. You can criticize my portfolio. Why you buy this stock? It's a lousy stock. You're very dumb. That's fine. And also on investing ideas and any ideas that even our community will bring up ideas that they are looking at and seek each and other opinion about it. I have one time where one of the members actually allows me to help him do a portfolio review. So he shares his entire portfolio with me, privately, of course, and then he allows me to discuss about it with all the other members. Of course, we keep his identity private, but he allows me to share what stock he owns and then give him a portfolio review to the community. So that's very something that we do within the community, and with generous members within it. There's a lot of sharing going on, and that's definitely one of the key points why it makes VIA Club so special. And our club members will always get members discount on all future events or product that we come up with. We are currently working on a small module of investment education product, and it will be released to our VIA Club members first, and at a discounted price. So all our future products or events, sometimes we do offline events, our VIA Club members sometimes can come for free even, or just at the nominal fee to let us cover the event cost. Whereas before we open up to the rest of the public. So these are all some of the perks that VIA Club members gets. And so you can see the list right here with your personal portfolio, your live trade, weekly report, and a podcast features and things like that. And if you look at all this, if you look at equivalent services out there, these are worth thousands of dollars. From our own estimation, looking at some of our other people who are doing it, it could be worth up to $2,000 plus US dollars. But in fact, our VIA Club members is really enjoying it with just a yearly membership fee of just 168 US dollars. And this is a by invitation only club. And since we are nearing the end of the year, we have finally deciding to reopen it for just this week, with a 25% discount for all you guys first time members if you're planning to join us. This means that it will only cost you 126 US dollars for the first year, and when you renew the next year, then you will go back to the usual pricing of 169 US dollars. So this is only a one-time offer for the week. And if you want to know more about it, what's even more interesting is you can try it out, and if you don't like it, within 14 days we'll give you a full money back guarantee. It has happened before because some people try it out, and then looking at some of the stock that I buy, he or she might feel that it's not suitable for me, and I'm not interested in all these stocks, and I don't want to track it. That's fine. We within 14 days, if you come back to us and say that this is not suitable for you, we will give you a full money back guarantee on it. If you are interested and want to just find out more about what's happening within VIA Club, you can go to this link. I'll provide the link down to on the YouTube channel as well, on the YouTube chat, bit.ly/clubvia. Okay. And you can definitely find out more about it, or if you have any questions before you take the next step, look at VIA Club, just give me a private message on Facebook Messenger or our Instagram at Value Invest Asia, and I would love to chat with you guys as well. Right? Yeah, you guys have been great today. Thank you all for all your questions and discussion. And the poll that most of us are looking at the sideline, and the great interest in Hong Kong right now. This really fascinating world that we are living in right now. I thank you all for your time, for spending the past hour with me. I really appreciate it. It's really all your enthusiasm that helps me continue to do this for the long term. And till we speak again, my name is Stanley. Invest safely, guys.